Welcome and good afternoon, and thanks for joining us for today's webinar, Cash Flow Management Considerations. Excited to get to talk about expenses and profit and cash and how that's going to all work. My name's David Blain. I'm a partner here at McKonly Asbury. I'm also the Director of Entrepreneurial Support and Client Accounting. And with me today is my sidekick, my colleague, Lindsay Young, Principal and Leader in Entrepreneurial Support and Client Accounting. Lindsay, why don't you say something? Say a little something.
Good afternoon, everyone. Looking forward to chatting with you all.
All right. There's some great pictures of both Lindsay and I. You know, probably not what you expected, but you know, we're cool accountants. Everybody likes hanging out with us. So we're going to move on here. As a firm, for those of you who don't know who McKonly Asbury is, we're an accounting and business advisory services firm with offices in Camp Hill, Lancaster, and the wonderful tundra of Bloomsburg, Pennsylvania. We provide a wide range of services to organizations across a variety of industries, as you can see on the screen, and we encourage you to visit our website and learn more. So if you, you know, a lot of our key services being affordable housing, construction, manufacturing, family-owned businesses and family-run businesses, nonprofits, healthcare, employee benefit plans. We do a lot of services in a lot of different industries. Happy to talk with you if there's any additional information that you want. If you joined us in past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on around us. Be sure to check out our website to catch past presentations as well as current information through our blog. All right, moving on. So today's webinar, if you have any questions to start with, you can submit them through obviously the built-in questions function there in the webinar control panel. Lindsay and I will, as the questions are coming in, we will try to address as many of the questions as we can as time permits. So feel free to submit those questions. For those of you that are looking to get CPE credits, and I know there's a lot. I know there's a lot of people that are interested in their CPE. We want to start out 2022 strong on the CPE side. Just make sure you're paying attention to the 3 polling questions because you need to answer the 3 polling questions in order to get credit for your CPE certificate. So be on the lookout for those polling questions as they come up. And if you meet all 3 polling questions and make sure you at least attended the 3 polling questions, we'll send you a certificate for your CPE within the next 2 weeks. All right.
Dave, you have such a great history of having really good polling questions. So I'm really anxious to see what you put in here today.
Yeah, you know what? I'm excited too about my own polling questions, to be totally honest with you, Lindsay. You know, I take a good bit of time coming up with them. So, all right. So anyways, the agenda today, we're going to start with, we're going to define cash flow. We're going to talk about profit and loss review. We're going to look at the balance sheet considerations and why the balance sheet's important to pay attention to. And then we're going to look at cash flow and impacts of valuation. Just as a high level, there's nothing that we're going to talk about today that's rocket science, as I call it. And in fact, a lot of what we're going to talk about today, you're probably going to say to yourself, oh, well, that makes sense. This is more of a reinforcer more than anything. Lindsay and I, running our entrepreneurial services and client accounting support practice, we see a lot of businesses on a regular basis that operate, and you know, the business owners out there running down the football field, as I like to call it, making things happen. They're selling product, they're working on operations, they're working with management. And sometimes, you know, as business occurs, we might lose focus or lose sight of key things on the financial perspective. So this is really meant to be a really good refresher course for those to just really how to better manage your finances and how to better manage your balance sheet, your profit and loss statement, and ultimately what your cash flow is. So, all right. Oh, went too fast. I think I went too fast. I gotta go back. All right, first polling question. Who wins the AFC and NFC championship games this weekend? So there you go. Everybody take a 30 seconds or so to digest those championship games and who might win in what we think Super Bowl, I guess it's 55. Is it 55 or 56 we're on now? I don't know. Do you know what it is, Lindsay?
I don't. I'm going for the Bengals. How about you?
I think the Chiefs and the Rams are going to get it done and be in the Super Bowl, but you never know. You know what? I'm not great at these polls. That's why I never win the McKonly and Asbury poll. So, oh well, we'll see. So I think we'll close this up. Let's see what this is. Oh, there it is. 43% are saying the Chiefs and the Rams, Lindsay. Chiefs and the Rams. You said the Bengals. What was your other team you're going to go with on the NFC side?
I don't know. I was thinking maybe the 49ers. So we'll see. It doesn't look like
That's
they have
only 9%, Lindsay. 49ers and the Bengals are only 9%.
No, not a good choice.
Not a good choice. You might want to go back and start watching the NFL game day and stuff like that to kind of get a better feel for these teams. All right. All right, moving on. Okay. So hopefully everybody got their first polling question, and otherwise you're going to be behind the 8 ball already. All right, so first thing we're going to talk about is cash flow and the definition of cash flow. While it might seem relatively, common sense, I think it is important to kind of just really identify and drive down to some of the basics of what cash flow is. So cash as a whole, it's really more than just what you see in your bank account. I mean, what you see in the bank or the bank account or the bank statement, is clearly what the bank is telling you what you have available and on hand, but it's not taking into account a number of other things. Obviously, from a cash reconciliation perspective, it's not taking into account checks clearing the bank, but it's also not taking into account other free and available cash items that you might have in your business. So free and available cash for operations of your business is really the goal. And from a valuation perspective, one of my colleagues here at McKonly and Asbury, Eric Blocker, who's a valuation expert, him and I work together on a lot of valuation stuff. Looking at free and available cash at the end of the day is really what drives business value. And the only way you get the free and available cash is to talk about some of the concepts that we're going to talk about today. So when you think about how do you define free and available cash, you're looking at earnings before interest, taxes, depreciation, amortization, better known as EBITDA to many. And from the perspective of EBITDA, a lot of organizations look at EBITDA as cash, because what that is it's taking your earnings and then you're taking out the non-cash activity or the activities that might get eliminated in the event that you were to pay off your debt, so you wouldn't have interest, or the taxes are usually post earnings anyway. So you're looking at what is my free and available cash flow. Discretionary cash flow, which is also just as important, is going to take into account what your net income is, plus your non-cash expenses, depreciation, amortization, any allowances, anything that's a non-cash related activity that's hitting your income statement gets added back. And then you look at things that are non-cash income, unrealized gains and losses, and principal payments on debt, asset purchases. Looking at these items together kind of really gives you a better feel of what your discretionary cash flow is. And that discretionary cash flow is also a really key value driver in your business, in what the value of your overall business is, because somebody's going to look at this and they're going to want to know what is that discretionary cash flow that ultimately this business is going to produce that's going to allow me to make a living. So cash flow definitions in my mind, as we start to talk about expense management and other balance sheet management, is kind of critical and important, because that should be some of the items that help make determining factors on how you want to manage your business ultimately, especially from a financial perspective. All right, moving on. So again, why is cash flow important? Just kind of reiterating again some of the concepts that we just talked about. Valuation, ultimately, at the end of the day, for a lot of small business owners, is really your retirement vehicle. For a lot of small business owners, that's going to be the asset in your life that you've built up the most. That is going to be that retirement vehicle, or the vehicle that you're going to turn over to a next generation or a next generation, maybe within your own family. So understanding cash flow and how it impacts valuation from the perspective of selling your business, estate planning, and transfer of ownership is very critical and important. Also, it's important for third-party users. So a lot of third-party users being things like being organizations like your financial institutions, your banks, maybe insurance brokers. They're going to also want to know the organization's cash and how much cash is the business actually throwing off from a discretionary purpose. because that's going to help them make determinations in underwriting loans, underwriting insurance. That's going to be the things that are really going to drive your ability to access additional capital. It's going to be your understanding of cash flow and how that impacts the value of your business. And then business understanding of how cash is used. I think we just kind of really talked about that in depth here to start with. So that being said, I'm going to turn it over now to my colleague, my sidekick, Vanna White, better known as Lindsay Young. And Lindsay's going to talk now about some more of the more detailed concepts of how we want to look at some things on the profit and loss statement in regards to better cash flow management. So Lindsay, I'm going to let you take it and run with a couple of things here. So,
Dave, cash receipts and the continuous monitoring of said cash is super important. Making sure you are offering various types of ACH, mobile deposit, or even remote deposit, possibly working with your bank to make sure that you can get a bank scanner to make sure that you can capture and make sure receipts are timely deposited. I also think it's good to be looking at your collection process, seeing that time frame in which you are physically receiving cash back through the door from the original time that you sent out the invoice. Is it truly 30 days? Are you offering some sort of a prepay or an early pay discount? Or do you have clients that are historically, a little bit behind the 8 ball that are paying in a 40, 45, or are you starting to see clients getting towards, customers getting towards that 60 days? So are you following up? Are you looking at that aged receivable? Are you sending statements at the end of the month? Making sure that you potentially look towards assessing possibly a late fee on the balance that's outstanding. Not all clients. Go ahead.
No, I was just going to say, Lindsay, I mean, one thing that I see a lot with a number of our clients is, again, it goes back to, we deal a lot with a number of, business owners that they're entrepreneurial in nature. They're really focused on sales, marketing, operations, and sometimes accounts receivable is something that can get away from you and can get away from you rather quickly. And that's and to me is, that's dead cash that's out there that's sitting waiting to be collected. And no fault of any business owner, they're just trying to run their business and they're focused on what's in front of them. And sometimes you got to look at those things like AR and the collection of AR, because having that cash available is going to help you better run your business more from the perspective of, you might not need to be on a line of credit. You might not need to you might not need to find, use your credit card, because you might have that additional cash if you go and collect those outstanding receivables, or at least offer something to entice your vendors to get you paid more quickly.
All good things to consider, Dave. Thank you. And if you have the ability to offer a discount for services rendered and can get cash in even faster, sometimes offering that discount is just the item that someone needs on their end to make sure they pay more quickly. One other item for consideration is kind of just those taxes that you are collecting. If you are selling a product that has sales and use tax connected to it, it is important to make sure you're looking at these as a liability, something that needs to be remitted down the road and earmarked for that payment coming up. Thankfully, the state also includes a small 1% when you do pay those timely. So again, making sure you have those funds earmarked and set aside for future sales and use tax payments.
All right. Moving on, expense management there, Lindsay.
Awesome. On the flip side, those vendors that you are paying for products that you are purchasing or services that you are purchasing, do they offer a discount for early pay? Many of these, sometimes you can see if you pay within 10 business days, you may be eligible for a 2% discount. So making sure you have that available and tracking that internally would be super helpful. Credit cards, refinancing any sort of credit card that you have, or possibly getting a 0% interest card, maybe gives you that little bit of break that you need and catch up on some back balances that you may have due. Additionally, it may also raise your credit score at the same time, kind of killing two birds, one stone there. Also, just taking a look at those credit cards. What types of credit cards do you have, and are they actually working for you? Do you travel a lot, and could there be air miles or even cashback rewards? We have seen quite a few clients recently with the cashback reward programs that are actually using them to offset and pay down their balance on a monthly basis. How cool is that?
Yeah, Lindsay, yeah, that is one thing that, definitely to take into consideration, especially now, right, with interest rates as low as they are. And, today the Fed announced that they want to start to raise rates starting sometime in March. And you're talking about potentially 4 or 5 rate adjustments this year. Now's the time to start to really look at, what are the balances that you have in some of your debt and some of your things like your credit card, and make sure that you're getting the best interest rate you can possibly get right now, and taking advantage of those points. I mean, I can't tell you how many clients of ours, you look at the amount of money that they spend on a regular basis. If we had good if you have good discipline on the spending side, right, and you're using your credit card and you're making sure that you're paying attention to the credit card balances and you're paying the credit cards down actively and you're not paying late, you're just going to build up good cash back, because most credit cards offer it now, right? They offer like 2% cash back on gas and fuel. They offer, maybe 3% cash back on supplies and purchases and things of that nature. So good if you can find those credit cards that have good interest rates right now that are offering good cash back incentives, and you have good financial discipline internally, it can really become a cash cow for you almost, right, Lindsay?
Absolutely. We're also seeing some of our clients utilizing credit cards and exchanging them in for gift certificates, and then later giving them out to various employees for a job well done, and help keeping their staff members on the right seat on the bus.
Yeah, absolutely. So it's just, when you're talking about credit cards, you're talking about payment terms, paying attention to those discounts that are out there, paying attention to things like the interest rates, cashback incentives really can all pay serious dividends for your organization if you manage them right.
I like that play on words there, Dave. Dividends.
Right. That's right.
That's accounting nerd jokes
That's
right
right.
there.
That's exactly right.
Well, moving right along into kind of that ongoing profit and loss statement review. I don't know about you, but SiriusXM is one of my favorites to give a call and say, hey, I need a better rate. And magically, it seems to work every time.
Isn't it amazing how it works with these technology companies, whether it's Comcast or Verizon or any of them, that you get a rate increase, then all of a sudden it's like, hey, I need a better rate, and they're willing to work with you. I mean, if you tell them that you're thinking about changing to another provider.
Magically, they always seem to have a new service agreement available, and just like that, we're back down to a really reasonable and affordable monthly payment. So looking at those various insurance programs that you're offering, cell phones, going out to bid, shopping around. I don't know about you, but I'm one to walk through. I don't buy the first pair of jeans that I find. I like to really find a good deal. So I suggest you do the same thing with your business. There are lots of ways to maybe even assess accounts that you're actually not using, or maybe you have a service line that you haven't used in years and it's time to go ahead and remove that off your ongoing monthly bill. That only positively impacts your future cash flow and your bottom line.
Yeah, absolutely, Lindsay. I mean, we have a lot of clients that have people in the field. They're they could be installing technology equipment or whatever they might be doing for that client, and the company's providing them cell phones. So you start to have a bunch of cell phones that are involved in your business, keeping track or making sure that you're following what those standard fees are for that cell phone, what the usage is on that cell phone, is really kind of critical, because those fees can escalate real quite fast, because we see those technology companies do not hesitate to just give you a rate increase. You know what I mean? Especially if they gave you a good discounted rate right up front, right, Lindsay? And then all of a sudden that term's over, and now all of a sudden you got a big massive rate increase. That's where you got to really pay attention in these standard agreements and try to make sure that you're on top of those for renegotiating those standard agreements. That really is a operational expense that can get away from you pretty quickly.
Additionally, don't leave those leftover cell phones laying around the office. If they still have some value to them, stick them out there, get some cash back for them on a local eBay or Craigslist, and put that money back into your pocket as well, especially if you have the need to kind of purchase new equipment on a regular basis. With the pandemic, we're starting to see a ton of our clients reevaluate the use of their office space. They're removing cubicles, they're kind of consolidating down their current office space, and even starting to sublet to have other people come in and utilize rooms in their office or offices inside their office space right now. So do you need all that space that you are? Is there a better offer down the road, and would it be worth it to move and possibly maybe even sublet some of that space that you're utilizing?
Yeah, I think that's that's clearly, I think, going to be the post-pandemic era issues that we're going to see here in the next couple of years. Is going to be rent utilization of office space, organizations downsizing their space and looking for more common use type of space. And this is where organizations really need to start to evaluate that. Look at the terms of their contract that they currently have for rent. Is there possibilities going back to your landlord for some type of rent concession or reduction to keep you in that space? Is there the ability to sublease some of that space because if you could sublease some of that space, to an organization that's looking to downsize themselves into a smaller space, maybe that's an option as well. So there's a number of different things you can do when you evaluate your space utilization.
So I'd say get out there, shop around, see if you can join a co-op, set those calendar appointments or those tickler files up when your expirations are set to expire on your various standard agreements, and make sure you call in and get those new rates.
Okay. Anything on utilities?
We do see a couple of clients out there who are shopping around for various energy rates and even participating in co-ops where they are sharing energy or sharing resources. Installation of solar panels is another one. We've had a couple of clients do recently, and they have seen some major reductions in their ongoing utility expenses. That being said, you need to make sure you're going to be in your office space for a while to make sure that the outlay of cash today is going to benefit you in the long term.
Sure.
Moving into
payroll. Yeah,
payroll.
employee versus subcontractor is always a major question that we get constantly, and how you define both. But clearly, this is a major issue to address. I mean, I'm not going to steal your thunder, so you go ahead, Lindsay. I'll jump in.
Thank you. No worries. No, as you said, it's continuing to be an ongoing debate. The IRS does a pretty good job of trying to make it pretty clear. If it acts like a duck, it's probably a duck. So if your employee is coming on site, you have standard work hours, a standard schedule, a particular dress code that they must follow, they are probably an employee. They look like and they smell like an employee. On the flip side, your subcontractor has all the flexibility in the world. They aren't required to come into the office at 8 o'clock, and they don't have to stay till 5. They're working on their terms, their schedule. They are coming and going. They likely have another client list. They have other roles and responsibilities, or maybe even another job. A lot of times having that contractor status seems very appealing to a client. You're not paying benefits. You're not paying a year-end match on a 401k or a simple IRA. You're not paying payroll taxes for them. So, there's some give and take there that you have to kind of look at And while I understand the attraction to the give and take, it really is oftentimes very clear if there is an employee versus a subcontractor. And we've actually seen it gone wrong, where we've come in at the end of the year. We are working through a workman's compensation audit. We're doing that annual good audit. And, they're asking the questions, well, what are they doing? And are they reporting on a regular basis? And then all of a sudden, they're assessing back taxes, back insurance on those people that really are not subcontractors that have been operating all along, kind of like an employee. Dave, what extra thoughts do you have on there?
Well, the first and foremost is misclassification of it between employee and subcontractor. You have the employer taxes that's involved with this, and correct me if I'm wrong, Lindsay. If the IRS came in and said that we believe that your subcontractor should have been classified as an employee, not only you as the organization owe the back employer taxes, but I believe you have to pay the employees payroll taxes on the Social Security and FICA as well. Is that correct?
I do believe so. If they had a 1099 out there, they would have probably paid some in already. So there would need to be a reconciliation between what they had previously paid. But sometimes they do come back on the employer as they were ultimately responsible for the remuneration for services rendered.
Yeah, so that's why it's an important cash flow matter, because not only is it a difference between some of the employer taxes and the benefits that the employer offers that that would be qualified to an employee versus subcontractor, but the penalties and potential interest on the fact that it was misclassified for a certain period is something that you got to pay attention to as well. That's why it's important to really pay attention on this side of the house with your payroll and how you classify employees versus subcontractors. All right, so I believe we're on to the next question. So I'm a big history guy, especially I love my time period from World War I to the end of World War II. And one of my favorite characters and generals was George Patton. Old blood and guts right there. Anyways, there's the question. George Patton, when he died, what did he die from? Did he die from wounds inflicted during the Battle of the Bulge, which was over Christmas and New Year's in 1944 to 1945? Wounds inflicted from a car accident? Did he just die from old age? Or did he die from thyroid cancer because he did like to smoke? So we'll give everybody a few seconds. Lindsay, what are you thinking on that one? What are you thinking?
I think I would probably go with wounds inflicted during the Battle of the Bulge. I mean, that sounds pretty reasonable. I'm not a huge history buff, though.
Yeah, you think about it. He was in charge of the Third Army, and the Third Army had to change course and go north, towards Bastogne, and during the Battle of the Bulge, and he led an 80-mile march over 3 days. So to relieve the troops there. So the answer, yes. So the old age is not the correct answer, and wounds inflicted during the Battle of the Bulge is not the right answer, and nor is thyroid cancer. Actually, George Patton died from wounds inflicted in a car accident after the war was over. He was in a car accident that paralyzed him, and then about 3 weeks later, he passed away. Interesting theories in regards to how that could have occurred. There's conspiracy theories out there that the American government killed him because he wanted to continue the war with the Russians. There was theories out there that the Russians killed him because he wanted to continue the war with the Russians. But nothing's ever been proven. But yes, he died from wounds inflicted from a car accident. How about that? Crazy. Crazy. You would have never thought it with a guy like that, a 4-star general like that. Anyways, moving on. So we're going to go on the balance sheet considerations now. We talked a lot about the income statement and income statement management, but just as important, Lindsay, is the balance sheet. Wouldn't you agree? I mean, a lot of times the balance sheet just does not get the love that it needs to get when you're looking at expense and cash flow management.
I couldn't agree more. A balance sheet for me is actually more important than a profit and loss statement. I think it talks more about your business and definitely is underrated by most clients and people. So absolutely, couldn't agree more.
Yeah. So in fact, that's our first bullet point. Balance sheet tends to be overlooked by many organizations. I mean, sometimes there's a lot of hidden bad gems, we'll call it, on the balance sheet that have significant impacts to your cash flow. Matters of old outstanding bills and invoices, accruals that are out there that need to be relieved and cleaned up. The balance sheet really, at the end of the day, does tell the health of the business. I mean, a strong balance sheet, you think about what a lot of organizations look for is they want to know what current ratio is and what your debt to equity ratio is. They are looking at, from a current ratio, how much current liquid assets do you have versus what you have from current liabilities. You want to always make sure that's at least 1-to-1 or better from that ratio. Most organizations, most banks are looking for 1.2-to-1, knowing that you're cash flowing more than what your current day-to-day bills are. And that's something that's really important to make sure you manage on the balance sheet. Keep in mind, the balance sheet is just a snapshot in time of the organization. So, while the income statement could, you might want to look at the income statement run over a 12-month period. The balance sheet is as of a point in time. So could be as of December 31st is what my cash position is, inventory, AR, liabilities look like, but it's usually as of a point in time. And if the balance sheet's not healthy, this will drag down income and earnings from the business, just like Lindsay, just like you and I were talking about. I mean, when you don't have a strong balance sheet where you don't have current good collectible receivables and you're not actively collecting on them, or you have old inventory that's out there that's not moving. I mean, that's really will become a significant drag on the balance sheet, because these are items that you're actually, if you think about it, financing, right? You're financing with other cash. When you're not collecting AR, you have to finance that uncollectible AR with cash in the business. Slow moving inventory is tied up cash that you use to buy that inventory that you're not cash flowing back in return to be able to move the business forward, maybe to buy new inventory or more updated equipment. So looking at these financial ratios that we list out here, current ratio, your debt to equity, critical ratios to really pay attention to really understand how your cash position looks and whether you can do certain things with your organization into the future. All right, moving on. So we'll start here with accounts receivable. When we talk about accounts receivable, we talked a little bit about this under cash collections and cash management. This again goes back to the balance sheet. Collectability of AR is critical. Being able to collect that AR and turn that AR around, typically in 30 days or less, is just that's cash generation for you. Anytime you go past 30 days into 45 and 60 days, then you get into a situation where you might have to use other cash to finance the AR it's uncollectible at this point in time. And there's a cost to that. There's carrying cost, right? There's carrying cost to carrying AR because that's cash that you're not collecting. Are you having to use your line of credit to continue to operate your business? If that's the case, then you're paying interest on that line of credit with AR that's sitting out there that you're not collecting. So really paying attention to accounts receivable and constantly driving its collection in having good day sales outstanding and turnover of your AR is really kind of critical and important. Looking at things like we talked about a little bit before, discounts, 210, net 30. If you're in an industry where you can offer maybe a small 2% discount in order to get your cash collected in 10 days, at the end of the day, getting used to that cash while giving a 2% discount is really, really, really important, because if that means staying off your line of credit, and let's say that your line of credit has an interest rate of 3.5% to 4%, well, you just save the arbitrage there of that 2% versus 3 or 4%, right? By getting that cash collection and not having to go onto your line of credit. So, just having good discipline around your receivables, ongoing invoice review, sending out customer statements on a regular basis, and monthly communications really is kind of really critical to that cash management. All right, Lindsay, I'll turn it over to you to accounts payable and talk a little bit about the liability side.
Thank you, Dave. It really sounds like spending that extra hour working on your AR collection certainly will make payroll a lot easier when that cash gets collected. Awesome. Moving right along into accounts payable. Similarly, on that 210 net 30, are you a vendor and do you have the option to expedite payment to one of your vendors to get that extra discount for early prepayment, similar to making sure you pay your sales and use tax on time, getting that 1% discount that the state offers as well. Looking at your payment terms, just in general, if you have a customer that is paying you consistently in 45 days for a product that you're shipping out, do you have the flexibility with your vendor to also accept 45 days? We do have a couple of our clients where they have worked out certain types of categories of purchases where they have married or matched up, making sure that their customer receive payments and their outgoing payments are on the same frequency. Certainly, it's more challenging when you have to advance payment consistently over time when customers aren't paying within that same frequency.
Yeah, I mean, like you were talking about with the discounts and everything. I mean, again, if you can, I've seen studies that say that if you can take the 2% discount on a regular basis, if you were to annualize that over the whole year, it's like 18% savings. I mean, that's pretty significant when you think about it, right?
It really is. And a client actually called me last week saying, hey, if I were to save, I really want to do this. I really want to do it. I did a real back of the napkin calculation. It amounted to 40 grand on their purchases, $40,000. I mean, right. What could you do with that? There's just open possibilities.
I don't know, Lindsay, what could you do with it?
Yeah, I think we could do a lot.
Lindsay, what are you going to do with that 40,000 you just saved?
I mean, we could do a ton. We could start a new avenue of business, right. Hire a new employee, add a new benefit. There's so much we could be doing with that. And they were like, wow, do you really think it could be that much? I'm like, well, according to what you spent here, that alone is a huge dollar amount. So exactly. Making sure, back to that discipline that you were talking about on the AR side, having that same discipline on the AP side is equally beneficial for you. Making sure you have an accordion folder, that you are reviewing it, staying diligent on entering your bills on a weekly basis, making sure you're making weekly or bi-weekly payments on those same bills that you're collecting, adhering to those ongoing terms, and have a routine process. I've never met a client that doesn't do well with the process. So making sure you have clear objectives and goals and really being efficient in that process really can pay a lot of dividends as well.
Hey, did you just say accordion folder?
Accordion folder, yes.
You know, we need to, you know what we need to do? We need to have a webinar on accounting history and talk about things like green bar paper and 13 column paper and accordion folders. I mean, you said accordion folder. I'm impressed. That's pretty cool.
Hey, Dave, I'll tell you, I still have my original green bar paper from when I started. So stop by. Nice. I'll give you a sheet. We could nice. Count it out later.
All right, on to debt there, Lindsay.
Awesome. Well, kind of tracking your ongoing debt balances, I would say one of the most common mistakes that clients are making are not breaking out the principal and interest. Oftentimes we will see payments being regular recorded and just almost in some instances duplicating and reducing their loan balance a lot faster than what it actually is. So making sure that you're using that split transaction option, especially in QuickBooks, to break out and reduce only the principal portion and make sure that the interest that you're paying is being particularly allocated to the profit and loss statement. And then as you are getting your statement in, going back and making sure that your balance on your balance sheet is tying into the statement on a regular basis. At a minimum, we need to be looking at that on an annual basis and making a one-time adjustment if we're not breaking that out on an ongoing monthly basis. Refinancing. We've seen quite a few clients that have done some refinancing, whether it's just to get an extension of terms. Sometimes in some instances is to get or take advantage of the lower interest rates before they're expected to go up here, and kind of buying that little bit of extra time, if you will, in the refinance process. They maybe save a payment or two, but then if they choose a longer term, reducing the overall monthly payment requirement. I mean, it's still going to be due eventually, but sometimes it just gives a little bit of breathing room that might be needed to pay down some higher debt obligations, such as a credit card.
Yeah, I agree with you. Yeah, I agree with you on the refinancing option. I mean, like we were talking about before, if we, now's the time to refinance before interest rates really start to increase. I mean, the Fed's going to have to increase interest rates to kind of curb inflation. They've already made statements that you're talking about potentially 4 or 5 rate increases this year. So now's the time to refinance and look at things like your working capital, working capital lines of credit. And if you can refinance those at lower rates, that you can lock in, I think that's important to do.
Additionally, on the lines of a working capital line of credit, if you are a seasonal based business and you are at the peak of your business season right now, and you know that there is going to be a turn and there's going to be a need till we get through the cycle again, making sure your financial statements are up to date, to go down to the bank and tell them, especially if your production is expanding, hey, I need this and I need an expansion on that line of credit. Oftentimes, if the bank doesn't like what they see on financial statements, they'll offer for you to personally guarantee it, or maybe put your home or a vacation home up as collateral against a loan. And we have a number of clients, Dave, and I know you've worked with many of them firsthand, to help them secure EIDL loans or even SBA financing. They have great terms on them, low interest rates, and certainly would be an attractive debt option.
Yeah, absolutely. On the economic injury disaster loan front, I mean, there was the COVID EIDL loans that pretty much expired at the end of December of 2021. But if you are in like a natural disaster area of sorts, you can get these economic injury disaster loans. So that's something to keep in mind. We got a question that came in here, talked about rate increases. I mean, what does M&A see as far as the rate hikes this year by Fed, and how much in 2022? Interesting enough, it was Tuesday night, I heard a presentation from some investment bankers at Raymond or at RBC Capital, and they said that the Fed has indicated upwards of 5 rate increases in 2022. Wow, that's pretty impressive, starting in March. And some rate increases could be as much as a 0.5 point. I mean, that's could be pretty significant. So you're right now, if you think about it, interest rates are almost zero, or if they're almost zero, if at zero. If you're talking about 1/4 to 0.5 point rate increases, you're still talking about pretty cheap money. You're still talking about pretty cheap money at the end of the day. But you could be talking about 2 or 3% rates by the end of the year. So pretty interesting. All right, moving on here. So going back to some of the stuff that you were just talking about, Lindsay, when it comes to refinancing, a couple things to keep in mind in regards to your financial statements and your balance sheet is that the banks are going to probably ask you for 3 years of tax returns. They're going to want to see internally, they're going to want to see good internal financial statements that are reconciled, that the financial statements tied to the tax returns. What type of taxpayer are you? Are you a cash basis taxpayer, an accrual basis taxpayer? These are going to be things that are going to be important that you really address with your internal financial statements. A lot of banks look for signed financial statements by the owner. The owner signed them off, say that the financial statements are in good standing, that they back those financial statements. And then sometimes the banks will also ask for a CPA required letter. And this isn't like, we're not talking about like a review or a reviewed financial statement or a audited financial statement. We're talking about some type of maybe lender verification to the bank from the CPA, saying that, you know, they're the accounts of record. They have, you know, this is what they do internally with the financial statements, to give the banks a little bit more clarity and a little bit more comfort over the numbers if there's not a reviewed statement or some type of audited financial statement to give them. So bottom line though is, long and short of it, you got to make sure all your financial information is up to date. Keep it up to date, stay on top of it, make sure it's actively reconciled and you're paying attention to a lot of the key details on your balance sheet and income statement. All right, Lindsay, you want to talk a little bit about credit card debt management?
Sure thing, Dave. Making sure that extra little cash that you have sitting around, go ahead, throw that on that credit card balance. Any little bit helps. Making sure you reduce your balance over time, and certainly it reduces that interest that you're paying. The more active that you can be in making payments, it only is going to increase your credit score, reduces your interest, and really getting out of those high interest rates really is what clients are looking to do at this moment. We are seeing a couple of clients that are getting a 0% card. We're migrating over. I've even seen a few clients recently using some other, what I would call non-traditional lending sources, such as like a PayPal loan or a fund box. I would be on the end of discouraging those unless they're in a dire need situation. A lot of times they have higher than average interest rates. They almost feel like a loan shark-esque, if you will, requiring daily payments or daily impounds from your cash balances. I think they make it really challenging to consistently manage your credit card debt and manage that cash flow that we've been talking about. So I think a 0% card really gets you back to a place where you can make payments over the next 6 months or over a period of time. Or even if you can't get that and you just need to throw that little bit of extra cash, any bit helps to start working towards trending on reducing that balance.
Yeah, the one thing about what you just talked about too is, you know, all of this good credit card management and debt management is going to help improve your credit score. And a lot of lenders are going to look at your credit score as well. I mean, that's things that you need to keep in mind, that, you know, while you don't see your credit score in front of you every day or your business's credit score, keeping track of that in regards to making sure you're making payments on time is kind of critical. All right, I think we talked a little bit about this already here, Lindsay, in regards to, you know, cash back and points consideration. Enroll in credit card auto pay. It's kind of funny. I just did that yesterday with just a personal bill, enrolling in like a credit card auto pay thing. So that while it's great that you make sure you're paying on time, you also make sure that you got the cash available to pay it on time. Hence, going back to cash flow management and really paying attention to your cash flow.
I think from the procurement card side of things, Dave, looking at who has access to your business credit cards, what type of limit do they have, and really kind of going back, is our card working for us? You know, are the people responsible at the other end? Are they eating out a lot? Is there other excessive use? Are they buying a lot of office supplies? And is there ways to potentially curb that? So making sure that limits are set for people who are using them, so they are using within their means. One of the other things that we talk about on here is making sure your credit card transactions are linked up or coming through on an automatic bank feed. Kind of seeing that more visual, timely recording of transactions really gives you an idea of what is coming through the account, what your future cash flow obligation is going to be if that card is set up on auto pay, and even potentially identifying fraud or fraudulent charges before the statement actually comes in. So if you see a large ticket item or a large purchase out there and you're like, what is this? Really, you could be looking at the back of your card, calling that 1-800 number and making sure that you're contacting them, letting them know that your card got hacked. So, you know, making sure that your card is ultimately working for you and that those team members, have what they need to do their job, but not more than what they need.
Yep. Okay. All right, moving on. Last and final thing on the balance sheet is owner distributions. How often do we have people call us and clients call us about a distribution and how much is going to be the tax on their distribution, and we're constantly having these conversations with them about the education of what a distribution actually is. So, basically, owner distributions just focus on frequency, but be consistent, helps with business cash flow management, determine if you want to make those distributions monthly or quarterly. If you want to take a monthly distribution, that's fine. Just try to make it consistent period of the month, and how that distribution is going to work. Or if it's a quarterly, maybe you take it right around the time that you have to do tax payments or estimated tax payments if you're doing that, and then do your distributions then. That way, you can better manage your cash flow in regards to what the cash flow needs of the business are versus the cash flow needs of what you need to use to pay taxes. Keep in mind, this is not a check. A lot of times, or the business owners think that this is like a paycheck, and it's not really meant to be a paycheck. It's really a return on the business income that you've either earned currently or you historically earned, and you're just taking a distribution against it. And a lot of, if you're doing distributions, you want to make sure that they're used to cover. You should use them to cover personal expenses and tax liabilities. That's really what those distributions are meant for. Not meant. You just caution whenever you're taking distributions out of your business is what this comes down to being. Because it does have an impact on cash flow. Best practice that we've seen, set 1/3 of your distributions aside to cover tax liability for any business income that is coming through the business that you're going to need to use that to pay taxes on. So just make sure you set some of that money aside. And again, on the tax side, it's consider potentially making estimated payments throughout the year. That way, if you got to feel that your income is going to be $100,000 for the year, and you pay that equally throughout the quarters, based upon the dates of the tax payments are due, that might better manage your cash flow from a business perspective, instead of having to take a large distribution at one period in time to pay taxes. That might cause some cash flow constraints, might cause you to have to dip into a line of credit, and now you're having carrying cost of debt on your books. But just being able to manage those distributions and how you're going to use those to pay taxes and other expenses, in also in regards to how you're running your business, is really kind of important. Common misconception: distributions are not taxable. Income generated from the business is taxable. So let's just make sure we're aware. Income from the business is different from distributions. Income is taxable. Whatever, if you're an S corporation or a partnership, you're getting a K1, it's coming down to your personal return. You're paying taxes on the income of that business. Distributions are just you taking cash out of the business on either income that's already been earned or historical income that was earned that you've already paid tax on. So there are two different separate things. A lot of times a lot of business owners think that the distribution is taxable, and a lot of times the distribution is not taxable. It's the income on the business that's taxable. You got to keep that in mind. Two different things. All right. Last and final item that I want to talk about real quick, now that we've kind of gone through the balance sheet, income statement review, is just going through some concepts on valuation concepts, because this is going to drive, I think, how you should look at your cash flow management in your balance sheet and income statement. So as we talked about before, cash is king. It drives the value in your business. It drives the value of what you're going to do with your business, whether it's going to be a retirement asset for you, you're going to sell it, you're going to transfer it to the next generation. But there's a couple different concepts in valuation here. There is a number of different approaches. A lot of times, most businesses are looked at more from an income approach. An income approach is usually like, what's the cash flow generation of the business versus an asset or a sale approach, we'll call it. Asset approach looks at the value of your assets. The sell approach looks at, what are market multiples out there. But there's a couple different approaches to valuation. There's discounted cash flow and a capitalization model. We talked about discretionary cash flow, and EBITDA drives cash flow. And consider the buyer's point of view. If you're in a spot where you're thinking about, from a business perspective, positioning your business to sell, you want to look at the buyer's point of view. Does the business generate adequate cash to make a living, and how quickly can they receive a return on their investment? Again, cash is king at the end of the day. The reason why cash flow management is so important is because of these very concepts right here. If you're thinking longer term about what you want to do with your business and how you want to position your business for a transition or the next generation.
Dave, we actually have a question that just came in. It is, I'm considering selling my business in the next year. What steps should I take to make sure that I can maximize my selling price?
Yeah, that's a really good question. I mean, a couple things you want to do is, let's start with expenses and then try to make sure that our expense base is managed. We're living within our means in the organization. That's going to drive bottom line income, and that's going to drive cash flow. Look at things like collection of old AR, old accounts receivable. Can you collect that cash, get that cash in the door to show cash flow generation in your business? I think loans is another thing. Now's the time. Again, we talked about refinancing debt. How can you possibly refinance some debt? Is there a chance to get lower interest rates of some of your debt? Lock it in now before those rates start to go up. I think there's a number of different things that you can do right now if you're in a spot where you're thinking about selling your business. I think it goes back to a lot of these cash flow concepts. Good cash flow management. Think about how your business is generating cash, and that's what you want to focus on, is how you can drive that cash. So let's get to this third polling question, because we're almost running out of time here, Lindsay. We've got about 3 minutes left. Last polling question. Who is Dale Carnegie? So is Dale Carnegie the founder of Carnegie Mellon University? The author of the book, How to Win Friends and Influence People? Former president of Pittsburgh Steel, not the Pittsburgh Steelers, Pittsburgh Steel? Or is all of the above? So I'm going to give everybody about 30 seconds to think about this question. Our producer today, that's working on this presentation, I bet you she knows the answer to this question on Dale Carnegie, because she's a Dale Carnegie disciple, we'll say. She works with a lot of our Dale Carnegie franchise partners. I bet you she knows the answer. I bet you do. I see that look on your face. So, Lindsay, what do you think the answer is?
Having been through the Dale Carnegie class, I'm going to have to say it's the author of the book, How to Win Friends and Influence People. I have a copy up here on the bookshelf.
So the answer is not all of the above, all right? And the answer is not the former president of Pittsburgh Steel or the founder of Carnegie Mellon University. It is the author of the book, How to Win Friends and Influence People. I tell you, if you haven't read the book, you should read it. It's got great principles in there that are lifelong learning lessons that are great for anybody at any age to read that book. So I would suggest that book highly, that you read that book. And if you're interested in Dale Carnegie courses, I would recommend that you talk to your local Dale Carnegie franchise. If it's South Central Pennsylvania or Maryland or Northern Virginia, it would definitely be the Dale Carnegie Mid-Atlantic franchise that you would want to talk to, and our good friend there, Carla Doyle. So I would say you should think about that. So I think we are at our time. It's 2:58. I don't see any other further questions that have come in at this point in time. So I will leave it here with everybody. If there's any other additional questions that anybody has, all my contact information is there. Lindsay's contact information is there. Lindsay and I are always open to questions. We're very responsive, and we'll get back to you very quickly with any questions or comments that you might have. Other than that, we appreciate everybody's time. In closing, we just want to say again, thank you for joining us for today's webinar. If you have any further questions regarding today's presentation, please feel free to reach out to one of us. A recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you who requested CPE, I hope you got all 3 polling questions. Those certificates will be sent out to you within 2 weeks. So again, thanks for joining us again today. Enjoy your day. Thank you very much.